Everybody, welcome to my shortened video series. This is for property, plant, and equipment, PP&E. The other one, not personal protective equipment, but property, plant, and equipment. This is my overview or part 0. This video is made by myself, also known as the accounting professor, Bennett Tchaikovsky. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any retribution, that should be redistribution, is expressly prohibited without the prior written consent of permission of the author. The opinions expressed herein are those of the author only and not the author's employers and or other affiliate organizations. Okay, so this is what we're going to be going through in this shortened series. And so property, plant, and equipment, this is something that is giving us multiple periods of benefit, right? And we're going to be showing this as a non-current asset on the balance sheet. Now, what you'll sometimes see is in textbooks, they'll call it long-term, right? It's the same thing. I prefer using non-current because it's the way that most publicly traded companies use it. And I think part of the reason why they will use non-current for both assets and liabilities, it just means that, well, current is the most important, which means we're going to use it in a year. Outside of that, it's going to be non-current. So but generally everything's going to be reflected as non-current. If you're taking intermediate accounting, there is one exception, but that's an asset held for sale, but we're not going to deal with that in the series. But unlike prepaid insurance, which is also an asset, when we're expensing the asset to show the use of it, we're not going to directly go through and credit the equipment account. Rather, we're going to use something called a contra asset account, which is accumulated depreciation. Okay, what does that mean? It's going to have a credit balance, and we're going to show you how that goes through and works. So right over here, assume that, how does this look on the balance sheet? Assume that a company has $1 million equipment that has accumulated depreciation of $200,000, right? When showing property, plant, and equipment on a classified balance sheet, this is how we're going to go through and show it. We're going to be showing our assets under non-current assets. We're going to be showing equipment. Then we're going to have less accumulated depreciation on that equipment. Is going to give us equipment net. What does that mean? Well, that means the equipment less the accumulated depreciation. This is something that is also referred to as net book value, right? So this is the carrying value of the equipment on our balance sheet. Okay, now let's take a look at a publicly traded company, because that's what we always like to go through and do on this channel. So over here, I'm at Apple, right? So not physically there, but we're looking here at Apple. This is for their quarterly report. It is for the period ended June 25th, their fiscal quarter ended June 25th, 2022. The reason why I like looking at Apple's balance sheets is that they are going through over here and they are using, essentially, they're distinguishing their current and non-current assets. So what you'll see over here is you'll say property, plant, and equipment net. That means that the depreciation has been taken out of it. Right. So if I come over here, now you might say to me, Bennett, well, if this is showing on the face of the balance sheet, then why are you showing the other part? Because we're learning accounting, right? And as we kind of come over here, there's something called financial statement footnotes. In the financial statement footnotes, they're going to show it at gross, which is what we were just doing there. That doesn't mean disgusting. It just means the total amount. So over here, Apple has $111 billion worth of equipment. They have depreciated that equipment to date, a total amount of accumulated depreciation or amortization of $71,516. What is amortization? That is a fancy word for something we have like a leasehold improvement, or if we have an intangible, right? So a leasehold improvement, that's not really, it stays with the building. So that's not really going to be something that we're going to be depreciating. Rather, it's going to be amortized. So that's an example in terms of what that goes through and what that looks like. Okay, so and again, as we're going through this and we're taking a look at it, we're going to be going through over here and covering some other topics, meaning that, recording equipment at acquisition cost. How do we record depreciation expense using straight line? How do we record it using units of production? How about double declining balance? And I'm not going to be covering something called sum of the year's digits. some of the year's digits. When I'm teaching, I always love to ask SEC, Securities and Exchange Commission examiners, when I see them at conferences, I say, have you ever seen some of the year's digits? And they say, well, I've seen it, but they didn't call it that. So it's more of an academic thing. We're then going to get into, well, we've depreciated. Now we're going to sell it. Like what happens there? So we're going to go through, and when we sell equipment, if we have a gain or if we have a loss, how does that go through and work? We're then going to be talking about repairs and maintenance expense versus betterments. Like, does it make it bigger? It's not really bigger, but does it make it better, more efficient if we're improving the asset versus just regular maintenance? And then lastly, we're going to be talking about changing depreciation methods. So that's the overview for this section, and I want to thank you for being with me here today. Please leave any questions you might have below, and appreciate your liking and subscribing to the channel. I'll see you on the next video.